Let me record. Okay, we are dealing with EPS, right? And what is EPS? Can anyone tell me what is EPS? EPS is earning per share, right? Earning per share. So this earning per share, we already learned what it is and why it is. What is the formula about it, and today we're going to look at the important, why is it important to have EPS, right, to do the calculating EPS for the company. And we also going to look at the limitation that EPS is giving to that cannot be achieved by EPS. Okay, that cannot be achieved by EPS. I will be sharing the screen with you. Okay, so here is important of earning per share. We know that the following highlights that we're going to discuss here. It's a few important of earning per share when it comes to measuring the performance or profitability of the company. Where is the company financial standing, right? Financial standing. So the importance of earning per share when we do the calculation, and this earning per share, it helps to gauge if the investing in the company would help investor generate more income, right? So if we say in simpler term, the higher the earning per share, it's indicate a profitable status of a company. If the company have the higher rate of earning per share, higher number of earning per share, then it indicate a profitable status, which in return, it's mean what? When it high rate of profitable status, it's indicate that if you as the investor investing in that company who is having high EPS, it is most likely that the company will increase the dividend payout over time. Increase the dividend payout. What is dividend? Dividend is the amount which the company pay out back to the shareholder. Okay, and you will heard this term of which we will study, equity share or preference share. All these, they will, it's like a investor who investing in this share, they are the small owner of the amount of share they're having in your company, and in return of putting their money, we collecting their money, it become our capital, right? Our capital to run the company. So with this, we have in turn paid out something called as dividend. Dividend is the payout that we return for their money that they have invested in our company. It's have percentage cut out, and it's mean that if the company have a higher earning per share, it will give out more dividend over the times, right? So it is important to calculate the earning per share before you start investing in a company, right? And then the second important is that earning per share helps to compare the performance of promising company to help pick the most suitable investment option. It helps you to pick a most suitable investment option. And similarly, with the help of EPS, investor, and the other financial method, okay, we are not just investing based on one method, but earning per share help investor. and can determine that whether the company existing and what is their company anticipated stock value, right? What expected their stock value to be, right? Their share value to be. And it helped to analyze their stock price and value per share and how its market performance. You know that in Mumbai, they have this Bombay Stock Exchange, right? Before this pandemic, our department used to take students for the field trip in Bombay Stock Exchange. We have done that for almost 2-3 years. Then, of course, everything shut down. This we are not able. But once we are getting back, which excitingly next week we are starting offline. So slowly everything will fall back into places, but nevertheless we should not forget the safety measure to maintain. Okay, let's continue. And let's say for instance, the investor use a price earning ratio. Along with price earning ratio, they are trying to compare and compute with the help of earning per share. So price earning ratio, you have to use the earning to divide it with your earning per share, which is to calculate earning per share. It further help with the earning ratio, which earning ratio help you to understand the anticipated market value for the company. And the next important why EPS is useful and it important, because EPS not only help measure a company current financial standing, but also help track the past performance, right? You can look back and see what is the past. The company may look well of that current year, but we are not sure. Sorry about that. Then it's not just sometime when we look at a company only at the current financial year standing, we are thinking, oh, maybe the company is doing well at that particular year. But before investing, you have to compare and look at the trends of the financial earning, the payout, right? The payout that some company may be having issue and not able to pay out for their let's say their stockholder, their shareholder for a few years, because they're not able, but only this last current year they started to able to pay out. So comparing this, so it means it's giving you a little high risk that, oh, before the company were not able to pay out their shareholders. So we have to compare not just the current situation, but EPS help us to measure the company past performance as well. And for instance, a company with a steadily increasing EPS is better than the one that it's a reliable investment option, rather than the one that the company suddenly have irregular EPS, which means this year they cannot pay out their dividends, and then next year suddenly they pay out double and then come back down. So this irregular company pay out dividend, it doesn't so flattering, or it call us the if you are not a seasoned investor. What is seasoned investor? Seasoned investor is investor who are look out for a short-term investment, and they're looking for reaping off the high peak of a company. So likewise, the earning per share, they can look for this company which faltering or irregular in their earning per share. But for investor who are looking for a steady and long-term investment earning, they will look for the earning per share that is steady, slowly increasing. right, at a regular pace. And then these are the 4 important why earning per share is helping us to see the company profitability and their financial standing. Okay, so I hope you understand these 4 points, right? Why is earning per share is important regarding the company profitability and financial standing. It's all about helping investor, right? You as the investor, when looking at to invest in some company, so we have to look for their earning per share. Then like any other thing, when there is advantageous and important, there's always a limitation into earning per share. We wouldn't say it's a disadvantageous. We use the term limitation. It means there's a certain go to the certain extent that earning per share could help you with those usefulness of it. So earning per share have considered to be a very potent financial tool. They must remember that, but at the same time, they must remember that earning per share have some drawbacks, right? So there are 3 drawbacks of earning per share. And this is for both investor and business owner, right? We just now we saw the usefulness of the for the investor, the advantageous and important, but now we're looking at the drawback, not just for the investor but for both business owner as well. And the first drawback and limitation of earning per share is that most business owner, they tend to able to manipulate the earning per share frequently, right? They are using this method, it easily manipulating earning per share, and this is projecting their venture as a profitable one. They have a way to play with the finance and accounting, right? Through this EPS, they can manipulate so that their figure, because people are looking at a high earning company, right? So if you're only looking at EPS alone to make decision investment, it sometimes could be tricky because EPS can be manipulated, and they are made attempt to attract the short-term investment, right? And it can hamper the business venture image and profitability in a long run though, if they begin to do that. But some company who are not looking for long-standing, they will do this such of thing. So one of the drawback of EPS is that it can be easily manipulated by the owner. And a second drawback is that since EPS does not consider inflation, the growth indicated by it may not be accurate at the first place. For example, let's say with an inflation, the overall price of the goods and services, they usually also increase, right? So in turn, this project is misleading the earning per share value of the venture. They fail to purchase or sell more good than it did a year ago. So the overall, it's less. It doesn't consider all factor. Why is it going up big? But so earning per share drawback, it does not considering the inflation factor, which is not making this earning per share, not giving the accurate picture of the company standing. And then the third drawback is that cash flow is an important aspect when it comes to gauging a company ability to repay their debt, right? Repay their debt. So this is calling us cash flow is meant to the ability to pay back to our debtor, and who are to pay back our debt to our creditor, right? This is, and who is our creditor? They are our those which we are like supplier, like even the shareholder, we have to pay them back the dividend. So the cash flow is not, but in the same way, cash flow is not considering in earning per share calculation. So which is mean that the high earning per share will still prove ineffective, right, for a company solvency. Usually when they look at a company, they're looking at a company solvency. What is solvency? Is the ability to pay out the debt. And how, if you remember the balance sheet, right? We have asset and liability, and under assets you have a capital, then it start with a capital and then current asset, then fixed asset. Then you know that the current asset is those assets which you can easily convert it into money, and this easily converted into money is to able to pay out their debt quickly. If there's an issue, they have the money flowing, we call it the cash flow statement, to cover it, to circulate around, to run your business, right? So that is important and show how effective the company is. But earning per share does not take cash flow into consideration, calculation. So hence it show one point, but it does not prove wholly or solely in the effectiveness of how the company can company solvency can be done, right? So hence what we can take away from after learning this important and limitation of earning per share is that before we are judging a merit of the company or as an investment option, right, to invest in some company, every investor should also check the performance factor as well. Along with earning per share is the performance factors as well. So in fact, it should be aligned, earning per share, with other financial parameters, right? To gain a fair idea of a business venture over scope, profitability, and market performance. So this is to prove to us, right? To prove to us that earning per share, they have suggested that it have their fair share of important and limitations. So before investing into anything, you have to compare that the earning per share and other well-being parameter or tool to measure this profitability and efficiency of the company. It at par. When we say at par, it means it's not widely different, because the company cannot just address the earning per share and address all other aspects. If the company is bogus, they cannot address other aspects as well. So before looking to compare, you have to see all parameters of the company rather than just looking at one aspect of the company. Right, so that is it for today. We have learned the importance of earning per share, and then in the next